Yes, good evening, students. Welcome to the session. I can see some queries right away. Yes, we'll take it up. Have you revised what we have done in the last class so far? Yes. I'll just quickly recap what we were on in the last class. So if you remember, we had started with in the last class, after the definition of royalty, fees for technical services, we had done the taxability under 44B, BB, presumptive taxation, all of that, right? We had done that. And then we had also done the special rates of taxes under 115A, 44DA. And we had also completed the other special rates of tax for the ADR, GDR, first proviso to section 48. So all those and chapter 12A is specifically. So all of that we have done in detail, and now we'll move on to the double tax relief. But before that, I could see some questions. I'll take it up. Yes, good evening, Geeta. Mansha, Apex Court Judgment Engineering Center of Excellence versus CIT. Royalty payment to non-resident for resale computer software is not exempt. It is not exempt. It is not considered as royalty. You cannot say it is exempt. Exempt means when there is a specific exemption from Income Tax Act. No, royalty payment to the non-resident for resale of the computer software is considered as royalty under the Income Tax Act. But as per engineering analysis judgment, as we had discussed that time also, it will not be considered as royalties under the tax treaty, because under the treaty, we do not have computer software included in the definition of royalty as we have it under the Act. And the provisions of the Act or treaty, whichever is beneficial, will apply. Okay? Yes, clear, Mansha? And the 2012 circular which you are referring, that is something which is there as per the notification. What is there is that the end user will not have to deduct the TDS. It is not something which is exempt. Okay. Yes, your next question is explanation to section 9, income deemed to accrue or arise in India to non-resident by way of interest, royalty, fee to be taxed irrespective of the territorial nexus. I didn't understand this provision because we assess the taxability in each case in interest, royalty, FTS if these payable to government, NR or resident. No, it's not like that. See, I'll explain you once again. So the provision, what it says is that how the royalty, interest or fees for technical services will deem to accrue or arise in India. It will deem to accrue or arise in India if the payer is a government or if the payer is a resident, unless it is for the business or profession of the resident, which is unless the royalty or FTS or interest is for the business or profession carried out outside India. And in case the payer is a non-resident, if it is for his business or profession carried on in India. Fine. Now, why this particular explanation was introduced, that irrespective of where the services are rendered, irrespective of whether or not the services are rendered in India or not. So if you remember, we had discussed the Ishika Wajima Harima case, wherein it was held that for the purpose of these services, specifically the offshore services, if these services are provided outside India and are not provided or rendered in India, but just are utilized or consumed in India, then fees for technical services will not be taxable in India or royalty will not be taxable in India. That was the finding of the Supreme Court. To override that judgment, it was provided through the explanation with a retrospective amendment that even if the services are not provided in India, even if these are offshore services provided outside India, in our case, it was the technical design, technical drawings, technical layouts, right? These were provided outside India. These were not actually rendered in India. Not provided in India means the personnel or the technical people were not coming to India and providing that service. So the Supreme Court had held that for the service to be taxable, for FTS to be taxable, the services should be provided or rendered in India. So to override that judgment, it was held that irrespective the services are rendered or not, even if it is just utilized and not technically provided here, it will still be taxable income. Are we clear? Yes, Mansha, is it clear? Purushottam, applicability of doctrine of merger will apply only on the subjects of assessment and reassessment. Yes, for that 163, 164, 154, so 263, 264 and 154, we had done that, right? It was applicable on that. Fine? Yes or no? Is it clear? Okay, perfect, Mansha. So we had seen the different tax rates. Basically, we had covered that in detail, different tax rates. We had covered the ADR and GDR. We had covered at the end the taxation of the non-resident sports person. So all of that, we have done that in detail. Now, next is the double tax relief obligation. So that is something which is important. Okay. So double tax relief obligation is what we are going to look at the moment. And then we will cover some miscellaneous provision as well, which are from the earlier chapter itself, but I'll cover it in there because these are kind of the compliance provision which we have to cover. Okay, fine. So now understand one thing. If you remember, I was time and again telling you that in respect of the tax treaty, wherever it is applicable, the provisions of the act or the treaty, whichever is beneficial, will be applicable. So section 90, which is there under the Income Tax Act, we'll talk about now section 90. What does it provide? So let's write down. Section 90 of the Income Tax Act. This is very important section. What does it provide? Section 90 subsection 2, or suppose we'll talk about section 90 subsection 1. So India enters into the agreement with the different countries. Now what are these agreements? These are the double tax avoidance agreement, the tax treaties, or as you may call it, double tax avoidance agreement or the tax treaties. These are nothing but the agreements or the contracts signed with the sovereign nations. Like the way you entered into a agreement, a copyright agreement, a rental agreement, those are the private agreements governed by the private law. These are the agreements between the two sovereign countries and are governed by the public international law. Fine. Now, what are these agreements for? So, let's say, for example, if there is a US resident, he is earning, let's say, interest income from India. He is receiving the interest income from India. Now, India will tax it because the payer is the Indian resident. So this will be deemed to accrue or arise in India. This will be deemed to accrue or arise in India under section 915. US will also tax it because it is earned by the resident of US. So there is going to be a double taxation in India as well as in US. So there is going to be double taxation in India as well as in US. Now, how do we avoid this double tax? India will tax, let's say, under section 115A at the rate of, let's say, 20%. Let's say US will also tax, let's say, at the rate of 30%. So out of, let's say the interest income was rupees 100. Out of this, 50 rupees is going into the taxes only. So there is a double taxation which is happening. Isn't it? So in that very case, in order to avoid double tax, the government enters into the tax treaties. Now, what are the tax treaties for? Tax treaties are basically an agreement between the two countries that they agree to resolve the double taxation for the taxpayers who are resident of either of these countries. Are we getting that? And how do they resolve the double tax? The double taxation is resolved by agreeing that whichever country will be the source country, their right to tax will be restricted. Let's say here in this case, India is a source country. India's right to tax is 20% under 1158. But let's say in India-US DTAA, India will agree that it will tax not more than 15%. So India is automatically curtailing the right, or US is curtailing the right of India to tax not more than 15%, even if the Income Tax Act provides for 20%. So the source country's taxing right is curtailed. Or let's say if it is a business income, then India can only tax the business income only if it will have the permanent establishment. Are we getting that? And the residence country will give the credit of the taxes paid in the source country. So this is how the double tax is resolved in the tax treaty. So source country right is curtailed and the residence country will grant credit of taxes paid in source country. So this is how the double tax agreements are framed. Now, from where does the income tax, where does the power comes to the country to sign these double tax avoidance agreement? Through our constitution, number one. Through our constitution, the income tax, these tax treaties are empowered to be signed. That is number one. And our Income Tax Act also gives that particular authority. So section 90 which you are looking at, that is something authorizing the government to enter into tax treaty. Section 90, what you look at, that is something which authorizes the income tax treaties to be entered into. Are we clear? Now, if you see this, section 90 subsection 1, what does it say? Section 90 subsection 1 talks about that the central government may enter into the tax treaties or may enter into an agreement with the government of any country outside India for the granting of relief in respect of the income on which income tax has been paid in both India and that other country, income tax chargeable under the Act, and the corresponding law in that other country. So, what does section 90 says? It empowers the central government to enter into the tax treaty with the government of other country, so as to avoid the double taxation. Are we getting that? So section 90, which is there, is the authorizing the central government to enter into the tax treaty. It is by virtue of section 90 that you could see the tax treaties. Okay, so section 90, subsection 1. Are we clear? So central government may enter into an agreement with the government of any country outside India for granting of relief in respect of income on which income tax has been paid in both countries. Okay. So section 90 subsection 1 is authorizing that. Are we clear? I'm putting here section 90. Yes. If you can see this. Clear? So this is something authorizing the central government. Second, the central government may enter into an agreement with the government of any country outside India for the avoidance of double tax of income under this act and the corresponding law in force in that country, as the case may be, without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including the treaty shopping arrangements aimed at obtaining relief provided in the said agreement for the indirect benefit to resident of other country. What does this mean? So see, the objective of entering into tax treaty is not just to grant the relief in respect of the income on which tax has been paid in both countries. That is one of the objectives. So one of the objectives is that if the income is subject to tax in both the countries, then in that particular case, India will have to grant the relief, and for this purpose, India is entering into the tax treaty with another country. This second objective is for avoidance of double taxation of income under this act. For avoidance of, the second objective is for avoidance of double taxation of income under this act. Now, how do I avoid that particular double tax? By restricting the source country right to tax. Is it visible now? I've zoomed in. Yes. So, for avoidance of double taxation of income under this act, how do I avoid the double tax? By restricting the right of the source country to tax that particular income. Either it can have no right to tax, it can have limited right to tax, like example I gave you, for the interest, for the dividend, for the royalties. Even if Indian Act provides 20%, if India agrees in the tax treaty that only 15% will be taxed, so then in that particular case, India can only tax 15%. However, What it additionally says, this sentence is very important. What it provides is, without creating the opportunities for non-taxation or reduced taxation through the or tax avoidance, including the treaty shopping arrangements aimed at obtaining reliefs provided in this agreement. What does this mean? So, let's take an example. The objective of the tax treaty are these: granting the relief in respect of income on which income tax has been paid in both countries, for the avoidance of double taxation of income. But let's say, for example, the Vodafone case. What happened in the Vodafone case? The Hutch Hong Kong had invested in the Cayman Island or a Mauritius company, right, which had then made the investment in the Hutch India, right? So this particular company was created as a special purpose vehicle, SPV. This was created as the special purpose vehicle. Now, when Hutch Hong Kong wanted to exit the Indian market, it sold the shares of this Cayman Island company to Vodafone UK. Why it did not directly invest in India? Because if it would have directly invested in India, if Hutch Hong Kong would have directly invested in India, what would have happened? There would have been no treaty benefit, because at that point in time, there was no tax treaty between India and Hong Kong. So there was no treaty, and therefore there would have been taxation as per the domestic law. So in order to avoid that taxation, it entered into India through Mauritius route. Why? Because at that point in time, under India-Mauritius tax treaty, capital gain was not taxable in India. Under DTL, India as a source country did not have any taxing rights. So if a Mauritius company invests in India and exits by selling the share, India did not have any taxing rights on the sale of those shares, because India had agreed that, like under the India-Mauritius tax treaty. Now, this benefit which was given under India-Mauritius tax treaty was given for everybody, or was for only the residents of Mauritius? This benefit which was given under the India-Mauritius tax treaty was given to everyone. Okay, you are a resident of China, you are a resident of US, you are a resident of UK, wherever you are coming from, please take the benefit under India-Mauritius tax treaty. Was it like for that purpose? Yes? No. It wasn't for, it was not for that purpose. It was only for Mauritius. Yes, Kaushiki, correct. So, it was, when a treaty was entered into with Mauritius, it was for that particular country. It's not that India in every tax treaty does not have the right on the capital gains which are arising on the sale of shares. It was only because India wanted to invite the foreign direct investment from Mauritius. These benefits were given. It was not given for all the countries. If it was for all the countries, India would have signed such treaty with other countries also. If we look at India, US, the capital gain tax is as per the domestic law. So India has not signed the tax treaty like that with every country. The treaties for every country is different. It is based on the trade relation. It is based on the bargaining power. It is based on how much foreign direct investment is coming from that country. Are we getting that? But these companies started exploiting the India-Mauritius route. These multinational companies started exploiting the multinational route, started exploiting the Mauritius route. And what is this called? Why they was exploiting this only Mauritius route? Because the treaty between India and Mauritius was favorable. You know, you go to market and you want to buy something. You want to buy clothes, let's say, or you want to buy a shoe. What you would do? You would ask every store, what is the price? Isn't it? And the best price where you will get, you will buy from that store. It's similar with the companies also. Instead of buying the particular goods, what these companies are doing is they are treaty shopping. This is known as treaty shopping. Choosing the tax treaty which is favorable with the source country and coming from that particular country instead of coming directly. That is known as the treaty shopping arrangement. Are we getting that? So in this particular case, this Hutch and several other companies had entered into the treaty shopping arrangement. Basically doing the treaty shopping, which is not permissible. But it was going on for many years. If you remember, we had spoken about the Vodafone decision of Supreme Court. There was Azadi Bachao Andolan decision of Supreme Court where these structures were allowed. But after 2015, when the OECD came up with the BEPS action plan, base erosion profit shifting, we have already discussed that, right? What is it? So these kind of structures were not at all supported, or these structures were criticized. And a statement was made at that time that this statement should also be included in the tax treaty. What is that statement? That the tax treaties are for giving the or for avoiding the double taxation. But remember one thing, these treaties are not for giving the opportunities of double non-taxation. In this case, the Hutch had no tax in India because capital gains were not taxable in India. India did not have any taxing right. Capital gains were also not taxable in Mauritius because Mauritius never taxed the capital gain under the domestic law. So there was the double non-taxation. There was double non-taxation which was happening. So a statement is now clearly put up under the tax treaty after the BEPS action plan that the tax treaties are not for giving the opportunities of double non-taxation or for treaty shopping arrangements to the resident of third countries. Third country means the resident, not the resident of India-Mauritius tax treaty. Hong Kong is a third country, right, between India and Mauritius. So that is what this statement is about. That the central government may enter into an agreement with the government of other country for avoidance of double tax without creating opportunities for non-taxation or reduced taxation through the tax evasion or the treaty shopping arrangements, which are aimed at giving the relief or which are for the indirect benefit of the or benefit to the residents of the third country. Are we clear? So this is what has been put up very recently under section 90 in order to explicitly provide that this is something not allowed. This is something which is not allowed. Are we clear? Is this understood very well? Yes. So the tax treaties will not give the opportunities of the double non-taxation which was earlier happening. Yes or no? Is it fine? Clear? Third objective of the tax treaty is exchange of information. Third objective of the tax treaty is for the exchange of information for the prevention of evasion or avoidance of the tax. So, it is not only that the treaty objective is to give the relief of the double tax, but the treaty objective is also for the exchange of information. So, for the exchange of information for the prevention of evasion or avoidance of income tax. Understand one thing now. See, you must have read in the newspapers about a year and a half back that there were many names which were coming out from the different paper leaks which was happening. Cyprus, Panama paper leak. There was information coming of wealthy individuals who have their Swiss bank accounts in different countries, which they have not reported to the income tax department. Isn't it? So what happens is that these individuals, these wealthy individuals, these companies, they make their bank accounts in the countries where the secrecy norms are very high, where there is a banking secrecy. For example, in Switzerland, they do not share information easily about who is the beneficial owner of the company, who is the beneficial owner of this particular bank account. And they used to avoid the taxes by not giving these information. In order to curb that, India has entered into a lot of exchange of information agreements, which are not tax treaties per se, which are not for the avoidance of double tax, but it is just to exchange the information in respect of resident of both the countries. So, India can get to know as to where the Indian residents have the income, where is their wealth being accumulated. And India automatically get this information periodically. When it will receive this information, it can then make the assessment on these particular individuals or the company, so that these individuals or the companies are not evading or avoiding the taxes. Are we getting it? And finally, the last objective of the tax treaty is for recovery of the income tax. For recovery of the income tax. Let's say, for example, if there is a resident of India who has not paid his tax dues and now he is hiding in UK. So in that particular case, India can request to UK under the tax treaty, there is a provision that UK will assist India in recovering the taxes, either by selling the estate there or recovering from his estate there or whatever income may be there. Are we getting that? So all these are the objective of the tax treaty. What are the objective of tax treaty? Granting the relief in respect of the taxes which have been paid in both the countries. avoiding the double tax without creating opportunities for non-taxation or reduced taxation through tax avoidance and treaty shopping arrangements, exchange of information and recovery of taxes. Is it clear? Yes, Kaushiki, you have correctly pointed out. The case is correct, but in that particular case, it was not the income tax dues which could have been recovered under India or UK tax treaty. There were other dues which were there, which were of the bank, which cannot be recovered under India US or India UK tax treaty. It is only when these are the tax dues that can be recovered. If it is dues which are payable to the bank, that cannot be recovered in the tax treaty, and that was the case there. Are you getting it? Yes, it was a bank loan. So it was a bank default which had happened in that case. Very good. So these are the objectives of the tax treaty. Now what does section or subsection 2 provides? It says where the central government has entered into an agreement with the government of any country outside India. Under subsection 1, for granting relief of tax, or as the case may be, avoidance of double tax, then in relation to the assessee whom such agreement applies, the provisions of the act shall apply to the extent they are more beneficial to the assessee. Shall apply to the extent they are more beneficial to the assessee. Now, what does this mean? As what I was telling you. So see, let's here understand with an example. Before we talk about this, or before we understand what does this mean, because an example will help you understand in a better way. So let's say there is an individual, or let's say there is company ABC Inc. Okay. There's a company ABC Inc. Now this particular company is, let's say, earning royalties from India, from the, let's say, Indian company. Now, if the payer is the Indian company, this will be deemed to accrue or arise in India. This will be deemed to accrue or arise in India under section 915. Under section 915, this will be deemed to accrue or arise in India. Now, if it is deemed to accrue or arise in India, this is clearly chargeable to tax in India. So step 1, you will always look into the taxability under the Act. Step 1, you will always look into the taxability under the Act. Then you will look into what does the DTAA provide. Whether this particular income is taxable under the DTAA also. So step 1 is that you will look into the Act, whether this is chargeable to tax under the Act or not. Step 2 is whether there is taxing right under DTAA. Now let's say under the DTAA, as per Article 12 of DTAA, under DTAA there are no sections, there are articles. This is taxable. So if it is taxable under the Act as well as under DTAA, then that means it is taxable in India. Now you will compare the tax rate. So your step 3 is what will be my tax rate? Let's say the tax rate under the Act is 10%. Let's say under the DTAA, the tax rate is 10%. Tax rate under the Act, under section 115A. It is 10%. Under the DTAA, it is also 10%. But under the Act, you will also add the 4% cess, which you will not add in the DTAA rate. There is no cess which is to be added to DTAA. DTAA rates are always final. So this is my 10.4%. This is my 10%. Now, which rate you will apply for the purpose of TDS under section 195? What does section 195 says? At what rate the TDS is to be deducted? Section 195. At what rate the TDS has to be deducted? What is the rate at which TDS is to be deducted under 195? You've already done 195. Kaushiki, what language does it use? Whichever is more beneficial? No. What does 195 says? Geeta, including cess, you will use that rate. What does 195 say? Which rate? What 195 provides? Let me see who gives me the correct answer. Yes, very quickly. Yes, Purushottam, very correct. So 195 uses the term rates in force. 195 uses the term rates in force. Isn't it? What do we mean by rates in force? What do we mean by rates in force? Rates in force are defined under section 237, isn't it? So rates in force are defined under section 237 to mean that 237 to mean that rate as provided under the Act or that provided under the DTAA. Are we getting that? So rate under the Act or that under the DTAA will be applicable. Here in this particular case, what is the rate which is I will apply here? What is the rate which I will apply over here? Yes, quickly tell me. Yes, what is the rate which will be applicable over here? Yes. What is the rate? Fast. The rate which is there under the DTAA and not the rate which is as per C. That is how much? 10. So that is something which is very high as compared to the rate under the DTAA. So here in this particular case, we will apply the rate as per the DTAA, which is just 10%. Are we getting that? Is it clear? So you will not apply the rate as per the Act, which is 10.4%. You will apply the rate as per the DTAA, which is the only 10%, which is without surcharge or cess. You will not add surcharge or cess to the DTAA rate. DTAA rates are always full and final. Clear? Any questions till now? Okay. So the 195 which is there is not using the term any rate. It uses the term rates in force. It uses the term rates in force, and rates in force means what? The rate under the Act or the rate under the DTAA. It is defined under section 237. Are we getting that? So use the terminology correctly even while writing in your exam. Do not write just that rate under the Act or rate under the DTAA, whatever, or just rate under the Act. Do not write like that. Fine. Now let's say, for example, if instead of royalty, this is, let's say, capital gains on sale of shares. If instead of royalty, let's say this is capital gain on sale of shares. Now what will happen in that particular case? Capital gain on sale of shares as per section 911 will be taxable in India. Capital gain on sale of shares will be taxable in India, isn't it? If capital gain on sale of share is taxable in India, it will be deemed to accrue or arise in India. Income from the transfer of a capital asset situated in India. Income from transfer of capital assets situated in India is deemed to accrue or arise in India. Right? Now, let's say under India-Mauritius Treaty, the capital gain on sale of asset is not to be taxed in India. India does not have the taxing right. So then, in that particular case, what will happen? The provision of the Act or the provision of the DTAA, whichever is beneficial, will be applicable as per section 90. So step 1, it is taxable as per the Act. Step 2, it is not taxable as per the tax treaty. Sorry. Then in that particular case, what will happen? The provision of the Act or the provision of the treaty, whichever is beneficial, will be applicable. Are we getting that particular point? So whatever is more beneficial will become applicable, either the Act or the treaty. So first you have to always decide for the scope of the total income, whether the income is chargeable to tax under the Act as well as the treaty both, and whichever beneficial is their provision, you will apply. In case it is taxable under the both, then you will check the tax rate. For the tax rate also, similarly, you will check what is the tax rate under the treaty, what is the tax rate under the Act, and whichever is beneficial will become applicable. Are we clear? Any doubt till now? Yes, any questions, any doubt? Yes or no? Yes, is it clear? So section 90, which is there, is laying out the objective of the tax treaty. Section 90 subsection 2 provides that the act or the treaty whichever is beneficial will be applicable to the assessee. Is it clear? Fine. Now section 90 subsection 2A, which is there. What does it provide? We saw about section 90 subsection 2, which says that the act or the treaty whichever is beneficial will be applicable. So if you remember, we had done that while we were dealing with the GAAR provision. Section 90 subsection 2. Does anyone remember? Yes, do you remember that provision? What was it? Section 90 subsection 2. What was it? Yes, fast. क्या हो गया? मेरे ख्याल से कुछ तो मुझे भी प्रॉब्लम आ रहा है बिकॉज मेरा स्क्रीन भी बंद हो गया है. मैं एक बार डिस्कनेक्ट करके फिर से करूँ क्या? हाँ मैं करती हूँ, एक ही मिनट दीजिए मुझे. Okay. So sorry, students, there was some technical glitch because of which the lecture interrupted in between, but we can just proceed from here. Okay, so we were on section 19. I think my screen also was is lost here. I'll again rewrite over here. So we were discussing about section 90. Right? And in section 90, we had seen that section 90 subsection 2 provides that the provisions of the act or the provisions of the tax treaty, whichever is beneficial, will be applicable. Are we clear? So first you have to look into the scope and then you have to look into the tax rate. So maybe you can write down step 1, or maybe just like this, you can write down. Check the taxability under the Act. Step 2, check the taxability under the DTL. Fine. So, out of this, whichever is beneficial will apply. And then you will check step 3. Check the tax rate under the Act. Step 4. Check the tax rate under the DTL. Again here, whichever is beneficial shall apply. Is it fine? Okay. Now we were on section 90, subsection 2A, which is with regard to the GAAR provision, and I was asking you what is exactly that. So the provisions of the GAAR, if you remember, even if these are not beneficial as compared to the tax treaty, the provisions of the GAAR, in case they are not beneficial as compared to the tax treaty, will still be applicable. Meaning that if you remember, we had seen that the GAAR will become applicable in a case where that if there is main purpose is to obtain the tax benefit. If the main purpose is to obtain the tax benefit, then in that particular case, the GAAR becomes applicable. Now, if the GAAR is applicable, and treaty will always provide that advantage. But in case your main purpose was to obtain the tax benefit, then in that particular case, the provisions of the GAAR will override the tax treaty. The provisions of the GAAR will override the tax treaty. That is what subsection 2A of section 90 provides. That even if the GAAR provisions are not beneficial as compared to the tax treaty, still the provisions of the GAAR will be applicable. Are we clear about this? Fine. Then moving further, as regards as the meaning of the term, as regards to as the meaning of the term which is used in the DTL, subsection 3 talks about, so section 90 2A was with respect to GAAR will override DTL. Fine. Now section 90 subsection 3. Meaning of the term not defined under DTL. So any term used in DTAA which is not defined in the tax treaty, but defined under the Income Tax Act. If it is defined under the Income Tax Act, then the meaning will be as per Act. Meaning of the term that it is assigned under the Act. If, let's say, for example, the term is used in the DTAA, but it is not defined under the Act as well as the treaty. So, not defined under the Act as well as DTAA, then the meaning will be as per the notification. Then the meaning as per the notification which is issued, that meaning will be taken. Are we clear? So in that particular case, the meaning which is assigned in the notification, that will be considered. Clear? Then comes section 90, subsection 4. Again, this is very, very important. So if you see, the treaties are intended to provide relief to the taxpayer who is resident of one of the contracting states. Because we were talking just now about the Vodafone decision also. The intention of India-Mauritius tax treaty was to give the benefit to the resident of Mauritius. So tax treaties which are there, these are to give benefit to resident of one of the contracting states. In the DTAA, you use the term contracting states. So, in order to restrict the benefit only to the residents of the contracting state and not to the resident of third state, we saw that there is now an explicit statement which is provided under section 90 that treaties are not to give the opportunities of double non-taxation. But in order to restrict the benefit only to the resident of those country and not the resident of third country, section 90 subsection 4 requires the non-resident who is claiming the treaty benefit to provide the tax residency certificate. Let's say, for example, if I am US resident and I want to claim the benefit of India-US tax treaty, what is the benefit which I'll claim as per India-US tax treaty? The benefit which I'll claim is that the India will, let's say, tax the royalties at 10%. In case I do not take the benefit, royalties will be taxed at, let's say, 10.4%. Are we getting that? So as per India-US tax treaty, if I am taking the benefit of India-US tax treaty, India will restrict the taxing right. In case I am not able to claim that treaty benefit, then I will be subjected to higher tax in India. Are we getting that? So, if I want to claim the benefit under the India-US tax treaty, then in that particular case, I will have to give the tax residency certificate, TRC. What is TRC? TRC is basically a certificate which is issued by the resident country. this is issued by the residence country. This is issued by the residence country to its resident, certifying that this company, this entity, or this person is resident of our country. Now, why this certificate is taken? This certificate is a kind of declaration or is a kind of proof that the benefits are not being claimed by the resident of the third country. The benefit is being claimed by the country's resident to whom this benefit was intended for. This may not be a conclusive proof that, okay, this person is resident, but is a substantial proof to demonstrate that, okay, if the government of the other country is saying that he is my resident, we will acknowledge it. So as per section 90 subsection 4, in order to claim the treaty benefit, India requires to produce the tax residency certificate. In our example, the USA resident will have to procure that certificate. Unless he procures that certificate, the treaty benefit will not be given. So along with the tax residency certificate, there is one more form which is required, which is form 10F. What is form 10F? It's a self-declaration form which just contains the particulars of that person, the name, the address, the country of which he is resident, the tax identification number, phone number, all of that. So it's just a form which contains the details of that particular person. In case the TRC does not have all the details. In case the TRC, let's say, does not have address, in case the TRC does not mention the year for which it is issued, then you will have to give the form 10F. 10F has those additional details which TRC does not. Are we clear? Any questions so far? Further, section 90 provides that, the explanation to section 90 provides that the tax rate in respect of a foreign company at a rate higher than the rate at which domestic company is chargeable. So if you see, for the foreign company, the tax rate is what? 40%. For the Indian company, the tax rate is what? 30%. Now, under the tax treaty, there is a clause which is called as non-discrimination clause. What is this non-discrimination clause? Understand this very carefully. These are very new terms for you. A non-discrimination clause means that I will not, as a country, will not discriminate between the foreign and the Indian citizens. I will not discriminate between a foreign and an Indian citizen in terms of the tax policy. Now, one can argue that for the foreign company, you are charging 40% tax rate. For the Indian company, you are charging 30% tax rate. This is a very clear-cut case of discrimination. So, under section 90, the explanation very well provides that the rate of tax for a foreign company, which is higher than the rate of tax for the domestic company, will not be considered as discriminatory. Will not be considered as discriminatory. So you can write down over here, rate of tax for a foreign company being higher than the rate of tax for the domestic company will not be considered as discriminatory. Any questions, any doubts so far? Yes or no? Yes, any doubts you would want to ask? Okay, okay. Now this was section 90, where we have the tax treaty. Section 90, subsection 1, authorizing the central government to enter into tax treaties for giving the relief of the double tax, for avoiding the double tax without providing opportunities for double non-taxation or reduced taxation through treaty shopping or tax avoidance arrangement, for exchange of information, for recovery of taxes. Section 90, subsection 2, that the act or the treaty, the provisions whichever are beneficial will be applicable to the taxpayer. Subsection 2A, GAAR, even if it is not beneficial as compared to treaty, will still apply because GAAR is an anti-avoidance regulation. Section 90, subsection 3, meaning of the term not defined in DTAA will be taken from Act if it is defined under the Act. If it is not defined under the Act as well as the treaty, then the meaning as assigned to in the notification. Next, subsection 4, that in case you want to claim the treaty benefits, you need to obtain the tax residency certificate. And in case there is information which is missing in the tax residency certificate, then you need to obtain also, then you need to provide the 10F. What is 10F? Form 10F is a self-declaratory form. It contains the details like name, status of that particular entity, nationality, tax identification number, previous year, assessment year for which the residency certificate is provided, address, all of that. Are we clear? Okay. Now, in case India does not have the tax treaty, it is not necessary India has a tax treaty with all the countries in the globe. India does not have tax treaty with all the countries. So, India may not have a tax treaty with certain country. For them, there is section 91 which is applicable, which is the unilateral relief. Section 91 is the unilateral relief with which, or to the residents, in case India does not have DTAA with countries. What does section 91 provide? Section 91 provide in case the income arising to an assessee in countries. Now this is relief to the resident. Section 91 is a relief to the resident of India. In case they have income from countries with which India does not have DTAA. With which India does not have DTAA. So assessee is a resident in India and the income is taxed in the foreign country. And India does not have DTAA with that particular country. In this particular case, as per section 91, India will provide unilateral credit of taxes paid in that foreign country. India will provide the unilateral credit of the taxes paid in the foreign country. How will this credit be provided? Let's try and understand. This credit which is there will be as per rule 128. This will be as per the rule 128. Now, what do we understand by section 91 and how do we calculate the credit here in this case? So, rule 128 provides the credit just like you have the credit of TDS, right? So, here also you will get the credit of the taxes paid in the foreign country, with which India does not have a DTL. But how the rule 128 provides is, it provides a deduction of that particular tax on the doubly taxed income. On the doubly taxed income. So the credit of the foreign tax will be given, and this credit will be computed for each source of income. Credit for each source of income. So the credit will be computed separately for each source of income arising from a particular country. And the credit would be lower of tax payable under the Income Tax Act, tax payable under the Income Tax Act, or the foreign tax paid on the income. Foreign tax paid on the income. Are we clear? So tax paid, so tax on the Indian income, tax payable under the Income Tax Act, or the tax which is paid in the foreign country, lower of that will be given as the credit. Now, you would have paid the taxes in the foreign country in foreign currency. So how will you take the conversion rate? How will you convert that particular tax? Because the tax would be paid in foreign currency in the foreign country. So, conversion rate. Even for the income, even your income will be in the foreign currency. So how will you determine your income also? How will you convert your income? So for conversion of the income, there is rule 115. You can write it over here. In respect of the salaries. For the salaries, the conversion rate will be taken as the TTBR rate, telegraphic transfer buying rate, as on the last date of month, as on the last date of the month, preceding the month in which salary is due, or paid in advance. Or in arrears. So you will take the TTBR rate of the last month. In respect of income from house property, as well as PGBP, in respect of income from house property, PGBP, or income from other sources. In respect of house property, PGBP, or other sources, you will take the TTBR rate. You will take the TTBR rate as on the last day of the previous year. Last day of the previous year. In respect of dividends, you will take as on the last date of the month, immediately preceding the month in which dividend is declared, distributed, or paid. And in respect of interest on securities, again you will take the TTBR rate as on the last date of the month, immediately preceding the month in which income is due. Are we clear? And in respect of the capital gains, you will take as on the last day of the month, immediately preceding the month in which capital asset is transferred. Fine. Now, as far as the tax rate is concerned, income tax is concerned, which is paid in the foreign currency, how will you calculate or how will you convert that? So for that, Rule 128 provides that shall be considered as the telegraphic transfer buying rate. So for the foreign tax, you will take the telegraphic transfer buying rate as on the last day of the month, preceding the month in which TDS is deducted or paid, or tax is paid or deducted. Are we clear? So for the countries with which India has a DTAA, we have section 90. For the countries with which India does not have the DTAA, then in that particular case, we have section 91. Are we clear? Yes or no? Yes, there's a question. Is it need to accept a non-discriminatory clause by a resident country as a part of DTAA? Yes, it is. If it is negotiated and if it is included in the DTAA, you have to accept. Kaushiki, I have written the dividend and house property and interest. For everything, we have the TTBR rate on it. All these are TTBR. Yes. I've written at the top itself, it is TTBR. Okay, I've just mentioned on which date you have to take TDBR. Fine. Shall we solve one question from your module itself? Yes. We'll solve one question from your module on this particular point. Yes. Okay. Okay. So I'll just share that screen. Okay. Mr. Kamlesh, an individual resident in India, age 52 years, furnishes you the following particulars of income earned in India, country X and country Y for the previous year 21-22. India has not entered into DTL with these two countries. Income from profession carried on in India, 7,50,000. Agricultural income in country X, 50,000. Dividend from a company incorporated in country Y, 1,50,000. Royalty income from a literary book from country X, 6 lakh. Expenses incurred for earning royalty, 50,000. Business loss in country Y, proprietary business, 65,000. Rent from a house property situated in country Y, gross, 2,40,000. Municipal taxes in respect of the above house in country Y not allowed as deduction in country Y, 10,000. Business loss in country Y not eligible for set off against other income as per the law of that country. Rate of tax in country X and country Y are 10% and 20% respectively. Compute the total income and tax payable by Mr. Kamlesh in India for AY 22-23, assuming that he does not opt for 115 BAC. Yes. Please start solving. Yes, what are the answers coming to? What is the house property income coming to? Tell me first about the house property income. How much it is coming to? No, Kaushiki, it's not coming to 1.58. No, total income is also not coming to this much. 2,75,400. No. What is your house property income? How have you calculated your house property? What is the gross annual value? What is the gross annual value? Very quickly. Yes, it is 2,40,000. So gross annual value 2,40,000. Then what will you do out of gross annual value? How 2.3, Kaushiki? It's 2.4, right? What will you do out of 2.4? Will you deduct the municipal taxes? Municipal taxes paid outside India? Will you deduct that? Yes or no? Yes, very quickly. Municipal taxes paid outside India. Will you deduct that? Yes, you have to deduct that. So for municipal taxes, there is no condition that it has to be paid in India. For municipal taxes, you will deduct the municipal taxes. Are we clear? So 10,000. So my net annual value will be 2,30,000. Then what about the standard deduction? Will we get the standard deduction? Yes. 69,000. Yes, correct. So standard deduction will be 30% of 2,30,000, 69,000, and your total income from house property will be 1,61,000. Yes, it will be 1,61,000. Fine. Now, what about the income from business or profession? What is the income from business or profession? What is the income from business or profession? First is income from profession 7,50,000, isn't it? 7,50,000. Then there is also a royalty income. Royalty income from a literary book from country X. So that also you will consider, but then it is gross, 6 lakh. So we'll reduce the expenses, which is 50,000. So which is 5,50,000. So 7,50,000 plus 5,50,000. Minus there is a business loss in country Y. So you will first set off the business loss. So business loss of 65,000. Kaushiki, there will be royalty income which also you will consider as the business income, right? So my business income comes to 12,35,000. Yes, correct. Correct, Mancha. Then income from other sources. How about the dividend income? 1,50,000 is the dividend income. Right? So that we will consider. Then what about the agricultural income? Will it be exempt? What about the agricultural income? Is agricultural income exempt in India? The answer is no. It is taxable. Yes, Mansha. So the agricultural income will be taxable. Agricultural income is not the Indian agricultural income. Only if it is Indian agricultural income, then you will exempt it. Fine. So then you will consider the agricultural income in India, which is 50,000. So 2 lakh will be my income from other sources. So what is my GTI coming to? What is my gross total income coming to? What is my gross total income? Give me the amount. ₹15,96,000. Yes. Will I get any deduction under chapter 6A? Let me see who answers it. There is a chapter 6A deduction available here. Which is the section? Chapter 6A deduction available over here. Yes, Purushottam. Very good. 80QQB. Royalty income of a resident from literary work. You can see it on the screen. Royalty income of a resident from a literary work is available as a deduction under section 80QQB, which is up to rupees 3 lakh. So here I will get this deduction of rupees 3 lakh from 15,96,000, which will come to 12,96,000. Here, since the total income is less than 20 lakh, the AMT also will not be applicable. Now on this, let me know what is the tax liability you are getting. What is the tax liability? Yes, Mansha. Yes, Mansha. Deduction for royalties available. Yes. What is the tax liability you are getting? Yes, Kaushiki, 201,300. But what about education cess? After cess, 209,352. Yes, correct. So 209,352. Now, how will you compute the foreign tax credit? Let me see who gives me the answer. First, for country X, we will have to go country wise. Okay. So for country X, which are the income which are pertaining to country X? One is the agricultural income, right, which is earned in country X. Second is the royalty income. Agricultural income and the royalty income. So what is my agricultural income? 50,000. What will be my royalty income which I will consider for the purpose of the double tax relief? Purushottam, very good question. Relief has to be calculated. Purushottam is asking, relief has to be calculated as per the foreign tax laws, or what if as if the income was earned in India by applying the foreign tax rate? Very good question, Purushottam. So the relief has to be calculated as if the income was earned in India by applying the foreign tax rate and not as per calculating the income as per the foreign tax law. Clear? So in this case, what will be your royalty income which is earned from country X? Royalty income, yes, will be, Mansha, very good, 2,50,000. So if you notice over here, my royalty income is 6 lakh, right? Out of which my expenses are 50,000. But I will also reduce the deduction under 80QQB. Why? I will reduce the expenses as well as the deduction under 80QQB because the double tax relief is given on the doubly taxed income. Double tax relief is given on the doubly taxed income. As you can see, what is my doubly taxed income? Doubly taxed income means the income on which I am paying the tax in India as well as in foreign country. In India, I am not paying taxes on the 3 lakh rupees which is allowed to meet as deduction. I am paying the taxes on 2,50,000 in both the countries. So my doubly taxed income is 2,50,000 and not 6 lakh or 5,50,000. Very important point over here. So my doubly taxed income will be 2,50,000 and not 6 lakh or 5,50,000. Those who have written 6 lakh or 5,50,000, put a big red mark on your page so that you do not make a mistake in exam. Now, what is the tax rate in country X? It is 10%. What is the average rate of tax in India? My average rate of tax in India is this particular 209,352 divided by my total income, which is 12,96,200. So the average rate of tax in India is 16.154%. Now, lower of these two is 10%. So on 3 lakh rupees, 30,000 will be the foreign tax credit. Are we clear? What about country Y? For country Y, we have again two income. One is the dividend from company incorporated in country Y. And second was the house property income as well as the business income which was there. Now, dividend income will take 1,50,000. What will be the house property income which we will take for country Y calculation? What is my house property income which you will take for the purpose of foreign tax credit? Kaushiki, did you understand? For the royalty income? Yes, Mansha, we'll take 1,61,000 because that is my doubly taxed income. So income from house property 1,61,000. Dividend is 1,50,000. And will I take the business loss which is there in country Y? Will I take the business loss in country Y? Yes or no? Will we take the business loss? Will we reduce that? Yes, Mansha, we will reduce that. So I am getting the benefit of that. So I will reduce that from the other sources, 65,000. And if you can see on the screen, income from house property plus dividend minus the loss set off, which gives me 2,46,000 as a doubly taxed income. On this, the average rate of tax in country Y is 20%. Average rate of tax in India is 16.154%. So lower of these two, I will apply on 2,46,000, 16.14%, which is 39,739. So my total foreign tax credit is 69,739. This I will reduce from 2,09,352 and my tax payable will be 1,39,613. Is it clear? Yes or no? Is this sum clear? Yes, quickly. Yes or no? Yes or no? Is this sum clear? Okay, perfect. So let's take a break of small break, very small break, because we have already had this technical issue. So 5 minute break, we'll get back and we are going to then move to the equalization levy. So a very small break of 5 minutes, not more than that. And then we are getting back with the equalization levy. Okay. So let's take a break of 5 minutes and then we get back with the equalization levy. Now coming to very interesting topic, which is equalization levy and the other aspects what we are going to discuss around that. So see, we have discussed already significant economic presence, section 9, what was there. Now we are moving towards the equalization levy. Now understand, this is very, very, very important area as well as very interesting. So how all this started? Let me tell you a story about this. Okay. This is a very interesting story. And it takes you, okay, there's one question by Anarga. First, let me answer that. How is 16.174% tax rate determined? Anarga, 16.174 is determined by dividing your total tax, which is 209,352, your total tax liability, divided by your total income, which is 12,96,000. That gives you 16.174%. Purushottam, is there any relevance for note mentioned in question 8? If yes, what if in the country Y brought forward losses can be set off against any other income? See, that is not relevant. From Indian perspective, you will calculate what is the permissibility of losses in Indian context. If it is allowed, then any which ways, if you see for the foreign tax credit purpose, we have set it off against the dividend and agricultural income. Okay? Clear, Purushottam? Okay. Now moving on to the equalization levy. So see, in 1991, when we had the liberalization, globalization, at that point in time, these computers and all were coming into India, right? So at that point in time, in fact, e-commerce operations were growing. It was, of course, not at that extent, but in 1991, we noticed that the e-commerce operations were picking up the pace. A decade later, in 2000, 2010, instead, the e-commerce operations were on a much higher scale. Fast forward to 2020, you could witness now everything can happen at a click. Especially if you see after the pandemic, the distance between us does not matter. You're able to listen to lectures from all across, wherever you are sitting. You may be in India, you may be outside India, does not matter. I am in India, I am outside India, does not matter. At the click of your mobile phone, you are able to order from any part of globe anything you want. So there is a rapid growth of information and technology, information and communication technology, or the digital technology. So in 1991, India had advocated that, or India had requested to the OECD that we need to change the existing rules under the tax treaty. Now, what are the existing rules under the tax treaty? Under the tax treaty, the business income under the tax treaty, there are different articles. Like we have under the Income Tax Act, different sections, right? Under the tax treaty, we have article, business income, royalty, fees for technical service, salary, which is dependent personal service, professional fees, independent personal service. So there are different articles, capital gain, just like we have it under the Act. You have different heads of income, there you have different articles. The business income is covered under Article 7. For the taxability of business income in the source country, there should be the permanent establishment. What is a permanent establishment? Till now we have understood a P means branch or office of a foreign company. Till now we have understood this particular name. But now you have matured. you have learned the entire income tax. We had started in December, right? With section 4. 3 months from now, you are very capable of understanding all the provisions of the income tax, isn't it? So now we will understand in detail what is the permanent establishment. Remember, we had studied the concept of business connection under section 9, right? The P is the version of the business connection in the tax treaty, but the business connection was not a defined concept. Remember, business connection was not defined. Only the explanation provided that the business connection includes a dependent agent. But a P is defined under tax treaty in Article 5. It is defined under Article 5. What does a P mean? P is defined under Article 5 as an office and branch, a fixed place of business, through which business of non-resident is carried on. P essentially means a fixed place of business through which business of non-resident is carried on. A construction site or installation site can also be a P if the construction is carried on, let's say for 90 days, for 180 days. Different treaties have different number of days. Employee of a non-resident can also result in a P if he is rendering services for certain number of days. Dependent agent is a one who habitually concludes the contract, plays a principal role leading to the conclusion of contracts, secures the order, maintains the stock and delivers the goods. Same points as it was under the Act. So all this can essentially result into a P, a warehouse, a sales outlet, right? These are your permanent establishment. And different treaties have different definition of P, but it's more or less around this. Now, if you notice here, the definition of the P essentially requires the fixed physical place of business. Physical location is important in order to constitute the P. Even if I have the P through an employee should come and render the services in India. Even if I say there is a dependent agent, an agent should be physically there in India. He should be concluding the contracts, playing the principal role, whatever. All these are essentially the requirement of having a physical location. But what is happening with the e-commerce operation? Do I need a physical place in India for providing these lectures? No. Do you know my location? I'm telling you, I'm sitting in Singapore at the moment. Do I have a P in India or do I have a business connection in India? Okay, you may say, ma'am, you have a business connection in India because you are earning the income from India, let's say. There is a business connection. I am rendering the services or I am providing the services, and there is a business connection, let's say through ICI. But do I have a P? Do I have a physical location in India? Yes or no? Do I have a P? No P. Yes, Kaushiki, correct. Purushottam, I'll answer your question again. We'll go back to that last question again. Okay. So I do not have a P. So that means, let's say, for example, whatever income I am earning, that cannot be taxed in India. Yes, Mansha, business connection is much broader than P. That's correct. So I have a business connection, but I do not have P. And as per section 90, subsection 2, the provision of the act or the treaty, whichever is beneficial, will apply. If I produce my TRC of Singapore, I can claim the India-Singapore treaty benefit. I will say there is no P, meaning my business income is not taxed. This will be considered as professional income, right? So this will not be taxed. So meaning, whatever income I am earning, I will not offer to tax in India. This is something which is one. The companies, the multinational companies which are operating at a huge scale, Amazon, Google, Facebook, Apple, these are earning super normal profit, especially if you see during the COVID period, during the pandemic. These companies were making this super normal profit. Do you know during the COVID period, how many digital companies emerged? Before that, you had not even heard about what is Blinkit, what is Dunzo, what is Zomato. There were so many digital companies which were emerging. Of course, those companies are the Indian companies and not the foreign companies. Isn't it? Zoom, for example. So there was no P and therefore this cannot be taxed. So India has been saying since 1991 to OECD that the e-commerce operations require the alteration under the tax treaty. The tax treaties need substantial alterations because with the existing definitions, we cannot tax the income from the e-commerce operation. At that point in time in 1991, the term used was e-commerce. Today we have moved to digitalization because that is a much broader term than e-commerce. Because at that point in time, the only thing which was envisaged was buying and selling through the websites. Now we have moved much beyond buying and selling through the website. You know, last time we were talking about Instagram. What is Instagram doing? What is Instagram doing? How is Instagram operating in India? What is the source of income? What is the business model of Instagram? Yes. So Instagram is collecting your data. Instagram is collecting your data. Do you see when you watch the reels on Instagram? Sometimes in between you find these sponsored reels. Don't you? Let's say, for example, if I'm watching let's say my content or my favorite content, or most of the time I, watch the reels on, let's say, some city for traveling. Let's say I'm watching the reels on travel. I really like to travel, so I'm watching the reels on travel. So now I search, let's say, in my Instagram account, let's say travel places, or let's say I searched maybe Himachal Pradesh. So I got the reels on Himachal Pradesh. Now I started watching one reel on Himachal Pradesh. Then the third reel will again be on Himachal Pradesh travel. The content creators which would have uploaded on the same, right? And those who would have used the same hashtag. In between, you will find, let's say, one hotel's reel from Shimla, which is, you will find a sponsored reel or a paid reel or an advertisement. Now, what will happen if you go on and click that hotel and you really like that? You will book that hotel. Now, how come that hotel reel is getting showed to you? That is getting showed to me because that hotel has paid to Instagram that the people who are watching Shimla or people who are viewing the reels on Himachal Pradesh or on tourism, show them this particular reel so that they can come on my page and book it. So therefore, what happens is Instagram is earning through sale of my data. Isn't it? Even if when you watch the status these days on Instagram, when you watch the status on Instagram, after one or two status, you will be shown the ads. You will be shown that hotel of Shimla. Isn't it? Because most of the time you are watching that content. Uninstall your Instagram and install again and read the terms and conditions. You will find the privacy policy. From there, you will understand that you're not paying for Instagram, but it's not coming for free. You are the product of Instagram, which Instagram is selling. So nothing comes for free in life. WhatsApp. Oh, when WhatsApp came in India, you thought that, oh my God, this is such a nice messaging service. You are able to send the messages in seconds. On SMS, you used to just get the delivery receipt or read receipt, but you can identify whether the person is reading, he's online, he's not online. You can use so many GIF, emojis, whatever. Such a free service, isn't it? Of lately, last 6-7 months, have you observed what WhatsApp is doing? Isn't your WhatsApp getting spammed? I at least get a lot of messages from Bajaj Finance, this, that. What is that? Yes, Kaushiki, business ads are coming. Why is it coming? Because WhatsApp is selling my data to these companies. The companies are buying that data and sending me these messages. At least I am getting frustrated out of WhatsApp now. Isn't it? So all these things are, it's now much more than e-commerce. E-commerce was just buying and selling. Now it's much more than that. Now the problem arises is, Mansha, it's not just the definition of P. The entire income tax, the entire international tax law has gone for a toss. Let's say for example, if you look at, let's say, any particular website. If you look at any particular website, let's say an hour back, I was searching for something on my apps, or I was searching on Google. Isn't it? Now you will open any website where the Google ads are coming. What you will find is, you will find that on those websites, the ad of, let's say, the shoe is coming up. Why is that happening? That is happening because your Google ads is also collecting your data. Your Google ad is collecting your data, and because of which your ads, what you have searched, are getting displayed. It is inducing you to buy that particular thing. Are we getting that? So that is how these particular companies are monetizing. Are we clear? Now the question which arises, let's take an example of one of the company. Let's say this Google. I went to Google website and let's say search shoes for women. Let's say I'm showing it to you. Okay. Let's see how it functions. See, Shoes for women. I searched it. Now, if you see, here it is coming sponsored. I'm getting Adidas, Amazon, Agio, Myntra, Amazon, Neiman's, Ellen Solly. So many websites are coming. Then on the top, it's coming Flipkart, buy shoes for women online in India, Agio. There are these trending products which are coming. There's this Amazon, Tata Click. So many shoes your website are coming. Isn't it? Now let's say I go to some other website. Let's say this website I had gone now. I think there were ads which were coming on this website. Yes. See here. Maybe the shoe ad is not coming, but I'm getting the ad of your Ready Reckoner. I think this website has stopped the ads of lately. But in case you know that there are many websites where you get these kind of ads. Let's say, for example, let me search some website where we can get these kind of ads besides it. And why do we get these ads? Because I search for it, Google is putting that information. Google is putting that particular information. So in this particular case, my data is being sold, and whatever the information is coming at the top, that information is basically the paid ads. These people have paid for it. Are you getting that? These people have paid for it, and that's how it is coming. So the question now arises that let's say the Google is operating a Google AdWord program. This is the software of Google. Google AdWord program. Now what happened in this particular case? Let's say, for example, if I search anything on Google and these ads are basically coming up. So when this ad comes up, this is something what the advertisers have paid based on the information what the Google tells them, or based on the keywords which the Google informs them. See, let's say I search sports shoes for women, sponsored. Now Adidas, while it is advertising for its shoes, it has put those keywords. Whenever somebody puts sports shoes, put this particular information at the top. Running shoes, see, shoes, sports shoes, they have put these keywords deliberately on their website. So that if you see, this is coming as sponsored. Isn't it? Now the payment which is made by these companies to the Google, whether this particular payment which is there, is it royalties? Fees for technical service? Or business income? What is it? Yes, tell me, what is it? The payment which is made for these ads. What is it? Quickly tell me. Whether this is royalty, FTS, what is it? Yes, business income. Why not royalty, Kaushiki? Why not royalty? Yes, quickly. Royalties, because it gives right to user to access the information. No, Mansha. Yes, Purushottam, business income. Why? No royalty because no human intervention. No, Purushottam, that is for technical services and not royalties. That is for technical services. Human intervention test is for the technical service. Okay, let's understand this. Why is it not a royalty? Because for royalty, there has to be a right to use. There has to be a right to use. A right to use a copyright, literary, artistic, whatever is there. Here, I'm not getting a right to use. I have a limited right on that particular advertisement I'm making. I'm not getting right to use in the copyright of Google. Google has this program. I do not have a right to modify that code. This is basically a software, right? I do not have a right in this particular software to modify it, to reproduce it, or to, do some kind of amendments to it. I have only a right to use this particular software in a limited manner. So here the engineering decision will be equally applicable. I do not have a right to use. So here no right to use. I am buying that particular limited right. I'm making the payment for advertisement. I'm getting the information about the keywords, and I'm then based on that keywords, I'm running the ad by making the payment. I'm not getting any right to use that particular software. Isn't it? I just have a limited right to run my advertisements. So this is a sale of online ad space. This is not a right to use. This is a sale of online ad space. This is not fees for technical services because no human intervention. This is the entire programming code. And here there is no human intervention. So this is not fees for technical service. For technical service, there has to be a human intervention. This will be a business income. But will it be taxable in India? The answer is no, because a website is not permanent establishment. A website is not permanent establishment. Are we clear? There was a decision in the context of, I'll show you. See. This was the website. Right Florist. There was an old decision of 2011 in the context of Right Florist. At that point in time, people used to send flowers through this website, and that is all across the globe. Now, this website had paid to Yahoo the fees for the online advertisement for the purchase of ad space. At that point in time, instead of Google, Yahoo was more prominent search engine. Now we have Google. So this particular website had paid to Yahoo the fees for the online ad space. And Kolkata Tribunal in that case, in the case of Right Florist, had concluded that here it will not be royalty because no right to use is given. Plus, this will not be taxable in India in absence of a P because a website cannot result into a P. So the question was that Right Florist had made payment to Yahoo for the online advertisement but had not deducted TDS under 195. So therefore, that judgment came in the context of Right Florist. Are we clear? So because of all of this, we had the BEPS Action Plan 1. We had the BEPS Action Plan 1 because there was no clarity on the taxability of digitalized economy. Now the word uses digitalized economy. So we had the BEPS Action Plan 1 by the OECD and G20 member countries. This was to study and suggest the new mechanism to tax the income arising from digitalized economy. So as I told you, in 1991, India had set up a high-powered e-commerce committee to suggest to OECD that the existing tax rules are not in alignment with the e-commerce corporation. In 1991, the OECD rejected India's suggestion to amend the PE definition by saying that the existing rules are capable enough to tax even the e-commerce operation. 20 years or not even 20 years down the line, in 2008, OECD said, no. The existing definition is not sufficient to capture the income from digital economy, and therefore we need the amendment. So when OECD had its members, OECD is a member country of rich countries, the developed countries, right? So the developed countries were having these multinational companies who were digital companies. Slowly, steadily, all these digital companies, if you see, are operating from Silicon Valley or USA. Earlier, Germany, France, Italy, UK were also having these digital companies. Now, slowly and steadily, all the digital companies are in Silicon Valley, which is US. So by 2008, after the Lehman Brothers crisis, after that, all these crises, it was observed that even the European countries are no more the residence country, because earlier the OECD did not want to share the taxing right with the market country. India is a market country, right? India is not a residence country of these digital companies. So when it was 1990s, early 2000, that time the digital companies were coming from all these countries. But after that, the digital companies are only based out of US. Most of the, at least, digital companies are coming out of US. So even European countries had become the market countries. And then they realized that even we are losing out on taxing right. And that's when they said that no, we need to amend the definition of P. And that's when they started with this BEPS Action Plan 1. From 2008 till 2015, for 6 long years, they studied on this digitalized economy, but did not come up with any conclusion. So we have 15 action plan targeting 15 different areas where the base erosion and profit shifting was taking place. And one of the important area of base erosion and profit shifting was the growing of digitalized economy. And hence it was put as the first action plan. But despite putting it as first action plan, They did not come up with any conclusion because even US is a member country of OECD. They just made some suggestions, the interim solutions. And what were the interim solutions? Introduce the withholding taxes, introduce the concept of significant economic presence, and finally the concept of equalization levy. But these are unilateral measures and not the permanent solution, because this will result in double taxation in all the countries. Even till now, it's 2023. From 2008 to 2023, we still do not have any agreement on taxing the digitalized economy. Imagine. It's been so many years that the OECD is not able to come up with the solution because US is always hindering on coming out with any solution or accepting any solution. Why? Because US does not want to share the taxing right with other countries. India said, fine, you don't want to share? Okay. India accepted the OECD's recommendation. Oh, you cannot see the screen or what? So sorry. Is the screen visible? Yes? Yes, Kaushiki, there is in GST tax on OIDR. Purushottam, why website is not a P? Because website is not tangible. It is intangible. The P definition does not have significant economic presence. It's the business connection under the Act where we have introduced the significant economic presence. Website is not a P. There will be business connection created because of significant economic presence. Okay, thank you, Jacob. Yes. So these interim solutions were introduced. India accepted the interim solutions. It said, okay, we are a big market country. US is saying that the profits which these companies are making, the digital companies are making, are only because we are supplying these services. But India is saying that, okay, you are supplying the services, but there is a demand. We are not doing anything. We are not into the supply side, but we are creating the demand. We have such a huge population. Your Instagram, your Facebook, your WhatsApp, your all these apps, our Amazon is functioning because we have such a big population. We have the users. Look at the users of Instagram in India versus in other countries. So India is saying, because you are having the demand in India, give us some share of tax. US is not listening to it, and therefore we are not coming up with any solution. So meantime, India has adopted these interim solutions. It has introduced the concept of significant economic presence, which we have already studied so far, which was what? Interaction with the users in India, soliciting the business activity, right? Soliciting the business, including the interaction with the users, and transaction in respect of goods or services, including the download of data. That is considered as significant economic presence. So even though it is not resulting in doing business with in a country, it is considered as that even if you are doing business with a country and not in a country, but there is an economic presence which you are having, which is a significant economic presence. It has also introduced the concept of equalization levy. So the equalization levy concept which has been introduced Yes, Mansha, we are also taxing the cryptos and virtual assets, which is very great. Yes, which is true. But this is now where we are talking about the equalization levy. Now, with respect to the equalization levy, in 2016, India introduced the concept of equalization levy. Equalization levy means to equalize the resident as well as the non-resident e-commerce players. Because a resident would say, on the same kind of business I am doing, I am paying taxes. And if a person is coming from outside India, he is not paying taxes. So therefore, equalization levy means equalize the impact. So there are two equalization levy. The equalization levy 1.0 and equalization levy 2.0. The first one is on the consideration received or receivable from the online advertisement. From the online advertisement. So the first equalization which is there, equalization levy which is there, is on the online advertisement. And what is that? Let's try and understand that. First equalization levy 1.0. This is on specified service, which is, let's say, there is Indian resident. The payer is the Indian resident or a non-resident having the permanent establishment in India. An Indian resident or a non-resident having the permanent establishment in India. The payer is the Indian resident or the non-resident having the permanent establishment in India. Okay. So Indian resident also carrying on the business or profession. Indian resident carrying on business or profession. It is making the payment for specified services. What are the specified services? The specified services are the online advertisement. Online advertisement, provision for digital ad space, provision for the digital ad space or any facility or service for the online advertisement. To a non-resident. So the payment is being made to a non-resident. So 6% equalization levy will be charged on that. A non-resident providing this specified service who does not have a PE in India. Not having the PE in India. And the aggregate amount of this payment is exceeding rupees 1 lakh. The aggregate amount of consideration is 1 lakh. In this particular case, there will be equalization levy at the rate of 6%. So, equal at the rate of 6%. Are we clear? So this is the first equalization levy which is applicable. Clear? Any doubt till now? So this is equalization levy 1.0. Second is equalization levy 2.0. Okay, this is also not applicable in a case where this is not applicable if payment is not for business or profession. So if it is for the personal use, equalization levy is not applicable. Are we clear? Then we have the equalization levy 2.0, which was introduced in 2020. Now this is at the rate of 2%. This is at the rate of 2%. In the very first case, which is equalization levy 1.0, here the resident payer or the non-resident having a PE in India, this payer has to deduct, like a TDS, the equalization levy at the rate of 6%. Whereas in equalization levy 2.0, it is not the payer who has to deduct here. It is the tax, or it's a levy which is charged on the recipient of the income. It is charged on the recipient of the income. Are you getting that? So in this particular case, in the first case, the payer has to deduct like TDS. Whereas in the second case, it is charged on the recipient of the income as an income tax only. Clear? Now this particular equalization levy 2.0, which is there, is on the e-commerce supply or services. So the charge of equalization levy 2.0, which is there, is under section 165A. This was under 165, not of income tax, but of Finance Act 2016. And this is under section 165A of Finance Act 2016. So the charge of equalization levy which is there is not under the Income Tax Act. It is coming through the Finance Act, and this is deliberately done. This is deliberately done because India does not want to allow the credit of the equalization levy, or so that in the other country, the payee is not able to obtain the credit of the taxes paid under the tax treaty. See, in case if it was provided, or this amendment or this particular levy was introduced through Income Tax Act, then what would have happened? Then you would have claimed the credit of the taxes paid in the other country. Similarly, you would have claimed the credit of equalization levy in your residence country, right? India does not want to give the credit. India wants to force the country to come up with or to amend the definition of P. Until they are doing it, India wants that the double taxation to happen. Because only then these countries will come up with some solution. Are we getting that? So deliberately it has been kept outside the purview of Income Tax Act. So equalization levy is not income tax. Equalization levy is not income tax. So deliberately it has been kept outside the purview of Income Tax Act. And that is why it is coming through Finance Act. Now, what does the Equalization Levy 2.0 provide? It is chargeable on the amount of consideration received or receivable by non-resident e-commerce operator. Non-resident e-commerce operator. So this equalization levy which is there is on the non-resident e-commerce operator. Now, what is this particular who is this e-commerce operator? Who is this e-commerce operator? Let's try and understand that thing. And what are the services on which the equalization levy will be charged? So section 165A provides that the equalization levy will be charged on the consideration which is received by an e-commerce operator from e-commerce supply or services. From e-commerce supply or services. To whom these supply or services are provided? To whom these e-commerce supply or services are provided? To a person resident in India, to a person resident in India, to a non-resident, in the specified circumstances. What are the specified circumstances? To a non-resident, when one non-resident e-commerce operator provides services to another non-resident for sale of advertisement which targets the customer who is Indian resident, or a customer who accesses the IP or who accesses the advertisement through IP located in India. Through the IP located in India. And sale of data collected from a person resident in India, or from a person who uses IP in India. IP located in India. And the third category is to a person. So this is A, this is B, and this is C. To a person who buys such goods, or services using IP address located in India. So on this services, e-commerce operator will have to pay the equalization levy at the rate of 2%. Are we clear? Yes. So in this particular case, number one is equalization levy at the rate of 2.0 will be charged on the consideration received or receivable by an e-commerce operator from the e-commerce supply or services made or provided to a person who is resident in India to a non-resident in case he is having the income from sale of advertisement which targets a customer who is resident in India or a customer who accesses Indian IP, and sale of data collected from a person who is resident in India or from a person who uses IP in India. Clear? And third is the person who buys the goods or services using IP located in India. Who is an e-commerce operator? E-commerce operator is an e-commerce operator is a non-resident who owns, operates, or manages digital or electronic facility. Digital or electronic facility or platform for online sale of goods or services. Okay, for online sale of goods or services. Okay, so the e-commerce operator is one who owns, manages, or operates the e-commerce, electronic facility or platform for online sale of goods or services. Okay. And what is the meaning of e-commerce supply or service? What is the meaning of e-commerce supply or service? E-commerce supply or service is also defined. So e-commerce supply or service means online sale of goods owned by the e-commerce operator, online provision of services provided by the e-commerce operator, online sale of goods or provision of services or both facilitated by the e-commerce operator, and any combination of the above. Okay, so e-commerce supply or service means online sale of goods, online provision of services, or online sale of goods or services facilitated through the online facility. Clear? Yes. And here also, like in the equalization levy 1.0, there was a threshold of 1 lakh. Here also, there is a threshold of 2 crores. So the equalization levy will not be applicable where a non-resident e-commerce operator, so this is not applicable where non-resident e-commerce operator has PE in India, or sales, turnover, or gross receipt of e-commerce operator is less than rupees 2 crores. Is less than rupees 2 crores. Okay. Any question, any doubt? Yes. Yes, IP means intellectual property. No, here IP means the internet protocol, Jacob, not the intellectual property. Jacob, digitalized economy is a wider term to denote all these, not the cashless economy. Cashless economy means I'm not using cash. Digitalized economy means that all these digital transactions which are taking place, because earlier it was just e-commerce. Now we have the sale of data, we have facilitation of the services through these websites. There are many things. So digitalized economy means that all these technological services or the goods which are offered through this digital platform. Yes, Jacob, we'll be talking about the compliances, the returns, as well as the payment of equalization levy, all of that in the next class. Which site will be make payment from equalization levy? Your normal TDS NSDL website. From that only you make the payment. Okay. In the next class, we are going to solve some questions and we are going to discuss about the compliances. Is that clear? Yes or no? I would request you to go through the equalization levy from your module so that in the next class, when we are solving the question, you will understand it in detail. I will discuss all these things again with the examples. Is that clear? Yes or no? Yes or no? Before I close the session, will you revise tonight whatever we have done? Thank you, Jacob. Good night. Okay. So please revise and see you in the next class. Okay. Thank you, Kaushiki. Thank you so much. We can close the session.